Rates may soon be falling faster than FTX. That was probably a little too soon. I'm sorry, I apologize. But there's some news that's coming up next week, and you're going to want to pay particular attention to it because it can also determine just where rates are headed as we move into 2023 and even beyond in 2024. The Fed is getting ready to meet again on December the 14th. And that next meeting is going to give us a lot of indications on where we may see mortgage rates heading. Now, what they're looking at in particular are the inflation numbers. And there's two common measuring sticks that the Fed is going to look at. One of those being the Consumer Price Index, or the CPI. Those numbers come out on December the 13th. Yep, one day before the Fed's meeting. Now, the CPI numbers essentially tell what consumers are willing to pay or will pay or have paid for goods and services. So for instance, if I go to the Apple store and I want to pick up that new Apple Ultra watch, I'm going to pay Apple directly. So consumer to company. That's the CPI, and that's what it measures. PCE inflation includes services for consumers paid by others on behalf of those consumers, so employers or nonprofit organizations. Think about it in terms of healthcare. So if you have a job, you pay into your healthcare, but your employer also subsidizes a portion of that healthcare, so they're paying a portion of it for you as well. The PCE takes that into account also. I'm not going to get into the metrics of how these indices are formulated, so the formulas are very different. Just know that the PCE formula is highly superior, and you would think that the Fed would use the PCE over the CPI all the time. It does and it doesn't to an extent. Historically, they've looked at the CPI numbers, but as of late, they've been also looking at the PCE numbers. And the reason behind some of this is because of when those two indices come out. Now, I told you the CPI comes out on the 13th, and it's usually somewhere in the middle of the month, where the PCE comes out later in the month. So because the CPI is first, it usually garners the most attention. Now, these indices are lagging indicators, meaning by the time the information gets to us, it's actually old.
Who you calling old?
About a month old. And because of this, the Fed has said that they're not going to look at these numbers in a vacuum. So they're going to look at them in totality. Now, it doesn't mean that they're not looking at them each and every month. It just means that whenever they're making their decision based on how to fight inflation, they're not solely looking at that month's data that comes out, because it's been up and down the past several months. So they're looking at it all together as opposed to just looking at one single month, because each of those months, if they did it that way, we'd be up and down and not knowing what in the world the Fed is going to do. So they're looking at it again, all in totality. But like I said, they are looking at those numbers each and every month. So when the CPI numbers come out for this month, if the numbers are lower than expected, expect to see mortgage rates go down, because the market will breathe a sigh of relief. Whew, thank you. However, if the CPI number is going up, that means inflation is increasing. Now, there's speculation that if the CPI number goes up, that the Fed is going to raise interest rates by either 75 basis points or 50 basis points. A lot of people are thinking 75 because that's what they've done over the past couple of months. However, most economists are thinking 50 basis points based off something that the Fed chairman said last week in terms of slowing down rate hikes as not to over-tighten the monetary policy. So they're essentially trying to not make it so tight that we go into what I'm going to call a hard recession versus a soft recession. The latter being one that if we go into, it's really easy for them to manipulate things in the government or with the monetary supply to bring us out. Yet, even with rate hikes, the chairman wasn't quite sure how long those rate hikes were going to last. So my prediction is we're probably going to see the Fed funds rate hovering somewhere between 4.75 and 5% throughout 2023 and possibly into Q2 of 2024. And that's why next week's announcement is going to be really key to the housing industry and as it relates to mortgage rates. Now, if you've been following my channel for a while, you're probably saying, but Dietrich, you told us that when the Fed raises the Fed funds rate, it doesn't really correlate to mortgage rates. And you'd be right, it doesn't. But there is some trickle down effect that happens. So let me explain. The Fed funds rate is really the rate that banks borrow from one another. So when that rate increases, it costs the banks more money to borrow from one another. And essentially, they pass that down to who? Us. So the rate of borrowing for the consumer increases. So when we go to purchase things like car loans, student loans, houses, those prices increase. So they bake that in based on the Fed announcement. Now, when that happens, the cost of borrowing goes up. And what usually happens is people stop borrowing money from the banks. They put it in their interest accounts or interest-bearing accounts because the interest rate on our savings accounts goes up. I mean, it's not a whole lot of money, but hey, you understand. Some money is better than no money. Now, when the Fed funds rate is lowered, like we saw in 2020 and 2021, where essentially the Fed funds rate was near the bottom at zero, the cost of borrowing for the banks was so low that they decided to pass that on to the consumer. Hence, we saw mortgage rates at 2.75 to about 3.5 or 3.6. Everybody and their mom wanted to get a mortgage, or they were refinancing their homes at that time. And that increased competition led to pricing increases. So that's why this is going to be really key to watch for next week. And if you're thinking about purchasing a house, my suggestion would be don't try to time the market. I know your cousin Bobo, whoever it was, told you they timed the market perfectly. They got their house, they paid pennies on the dollar for it, and they're suggesting that they can help you do the same. Put a pause on that, no cap. Now, if they were able to do that, which I know they weren't, they should be able to repeat that process over and over and over again. And if they could do that, they would be millionaires or billionaires. If they're not, don't listen to that advice. Even if they are, don't listen to that advice because lightning tends not to strike in the same place twice. So don't try to time the market. But what I will tell you is to be informed and make the best decision on when you want to purchase based on your particular criteria and your needs. Now, I will say this is probably one of the better times to purchase, even with higher prices and higher interest rates. We're starting to see some softening happening with prices as sellers are getting more realistic and not pricing based on what was happening in 2021. So prices are starting to come down. In addition, some sellers are offering incentives. So they may be offering concessions or credits. You in turn can use those credits to purchase discount points or do an interest rate buy down. You're also able to do something now that most people probably would say is taboo based on what happened in 2008, but it's a different time. So you can also look at doing an adjustable rate mortgage that will lower and essentially lower the interest rate that you're paying, because the adjustable rate mortgages, when you look at them versus the 30-year fix, much lower. So you can look at doing an adjustable rate mortgage. Now, I talk about how these things work in these videos right here. So watch those next.